Thank you so much. Okay, so we're looking at the next section. We're saying the auditor's use of the work of internal auditors. And the key idea around using the work of the internal auditor is if the internal audit is effective and functional, then it's relevant. So the editor must decide whether to use the internal audit work, to decide what extent, which areas to use, and whether the work is adequate for audit purposes. So it depends on the auditor's judgment. And the hook around this is you can use the auditor's work, but prove that work works. So the auditor needs to prove that the auditor's or the internal audit work is okay, it works. And in doing that, he needs to evaluate the internal audit work before he relies on it. He needs to evaluate it, and he can evaluate it on 3 fronts. Can evaluate the internal audit's work in 3 fronts. Number 1, you can use the acronym OCC. You could evaluate the internal audit's objectivity, his competence, or the team's communication. So the objectivity or status speaks to questions around, is the internal audit independent of management's influence? Very important. And the independence could generally look around areas of who the audit reports to. Does the auditor report to the board or the audit committee? That's a good objectivity status. But if the auditor reports to finance director, that's a problem. Of course, we internal auditors have dual functionality. Functionally, you report to the board or audit committee, and administratively, you report to the CEO administratively, of course. So we have this dual reporting line. So administratively to the CEO, then functionally to the board, which is principal. But where an auditor is subjected to report to finance director or finance manager, that's an objectivity. Objectivity is eroding. The purpose of internal audit has failed. Somebody you are supposed to be checking, you are reporting to the person. That's an objectivity status that has flawed. So when such status is found out by the external auditor, he cannot rely on the work of the internal auditor. He also need to ask, does management act on the internal audit's finding? Do they resolve? So if management ignores internal audit findings or reports or observations, then reliance on the internal audit work is risky. So if internal audit answers to finance, then let them finish your dance. Don't let them finish your dance, as the external auditor is a hook I put here. If they report to finance, then objectivity is already, just ignore the work of the internal auditor. Also, another area is the internal auditor competent? Do they exhibit due care? You could ask, are the internal audit staff or the chief audit executive or the internal auditor or the central, whatever acronym they use, designation, are they qualified and experienced? Do they show professional care in planning their audit plan, their documentation, their job review? I could remember one of the comments of the external auditor, or my external auditor that I worked with in PwC, with PwC, the former place I worked. He said something on my report. He said, "Man, okay, your report no be small. How many pages? Risk, compliance, internal audits, man, sir, they work." So you see, where you get such comments, it shows to some extent that they could rely on the work. So your reports, documentation, reviews tell, or as auditors, external auditors, how much the external auditor could rely on the work. So you need to think around skilled staff, around competence, and solid support provided to the internal audit units for the external auditor to rely on the work. Then communication. External auditors and internal auditors should share findings and meet regularly, which we do. Both functions are part of the third line of defense. The external audit and the internal audits are on the third line of defense. So they must inform each other of issues that could affect the audit work. I had a significant fraud issue in my last place of assignment. And aside informing management, I had to call the external auditor that look at it. This is what is happening in the lab. This is it. This is it. It was like, wow. That means that lab component, their revenue will have been overstated by this amount you just found out. I said, yes. He said, okay, let's see your final audit report. So we share findings. So the hook is no talk, no trust. You have to verify. You can't trust as an external auditor the internal audit work. You have to verify it by substantiating it with evidence. The next thing is to evaluate the specific work. The external auditor should evaluate the specific work of the internal auditor by assessing the internal audit department. If it's a one-man department, if they have a number of staff, he must test the specific work done by the internal audit to validate it. He should also consider the nature and scope of the audit's work, the risk level, the highest risk that he should place less reliance on based on the areas or coverage by the internal audit, and also the subjectivity of the internal auditor's judgments around estimates, whether to place less reliance or more reliance on it. Also, the auditor needs to test before he trusts the work of the internal auditor. He should verify that the internal audit work is sound. He should check areas around the internal audit staff's training and proficiency, how they are properly supervised, whether they are external quality reviews, who he reports to administratively, functionally, who are those that are doing external quality assessment of the auditor. That time I was with my former place of assignment. The parent company auditors do us EQAs every quarter. So those are ways to properly supervise also the internal audit. Sometimes process owners think nobody audits the auditor. Of course, you are audited. They check your quality reports. If it's a holding company, some audit committees assign another audit firm to check their internal audit function if it's robust and efficient. So those are ways to ensure the internal audit is also doing a good job. Also areas of evidence, sufficiency, and appropriateness, and how the auditor comes to conclusions. How logical are the conclusions? How are the issues, the observations, exceptions resolved by management? So the external auditor needs to perform tests around reperforming auditors' job done. He needs to perform tests to evaluate what is done. He needs to test similar items. He also needs to observe the internal audit procedures in action. So he has to trust, but then he has to test and verify before he trusts the auditor's work. He also needs to check around areas of documentation. All evaluations, discussions, and testing results must be documented in the external auditor's working papers, and it must support the audit quality and accountability of the internal audit. So, for example, in my former space, I use an example here, the diagnostic center. The audit team or my team review internal controls. So the external auditor normally checks the independence. They also send their external auditors to the end of the year stock count with the internal audit, confirm qualification, and retest some of the few sample items. So they do sample of sampling of, what do they call it, of inventory items at the end of the year, while auditors do full scope. So it's a way of validating and being satisfied, and also it reduces some of their work because they are fully responsible for the audit opinion, but then they do part of it and rely on the auditor's jobs, work done. So the quick memory hook, you could use this ICAN to rely on audit work. You could use that hook to remember stuffs around, number one, independence, talking about the objectivity of the audit team, his competence or the team's competence, and the adequacy of the work done, review and supervision, who reviews and supervises the audit work, and also evidence supporting the audit conclusion. So this acronym could help you remember the conversation around auditors using the work of internal auditors. All right. Any question on this? A lot of people have left the call. I believe we are not used to this 8 to 11 class, but then it's imperative. We have no choice. We have to run. All right. Any question on this? Second section.
Good to go,
okay,
sir.
if we
Good to go.
Yes. All right. If we don't, let's move to the next unit. We just finished the unit on the external auditor relying on the work of the internal auditor. All right, so let's move to Unit 8 very quickly. Let's look at the audit of accounting estimates, and the standard that covers or guides that is ISA 540, the audit of accounting estimates. So let's pay attention, quite a tricky unit, and it is quite tested in the AAAF paper. Estimates, accounting estimates, quite confusing and quite challenging, but then it's simple, but it's not easy. So it's simple in the sense that pay attention, you'll be able to grasp the concept very clearly. So let's look at the first section on the nature of accounting estimates and the audit problem. The nature of accounting estimates and the audit problem. So what are accounting estimates, you could ask? They are management's approximation of monetary amounts when they cannot have precise measurement. So they approximate. That's what estimates are all about. You could think of them as approximation when actual or monetary amounts cannot be pinned or pinned directly to a particular accounting transaction. So ISA 540 defines an estimate as an approximation of a monetary amount in the absence of a precise means of measurement. So remember a hook around understanding the estimates conversation. When numbers can be counted, they must be estimated. And that's what estimates are all about. When numbers cannot be counted or provided, they must be estimated, which is what management do. So common examples around estimates are depreciation is an estimate of an asset's useful life or its residual value. Accruals and prepayments are timing-based estimates, and also provision for legal disputes. The outcome could be unknown. So those are examples of estimates. Deferred tax, depending on future profits and tax laws, are also estimates. Then allowance for doubtful debt, the former dispensation. Currently, we call it expected credit loss. And it depends on customer behavior. These are estimates. So you could use this mnemonic to remember that LP, talking about estimates. Depreciation is the D, A is the accruals, D is doubtful debts, legal provisions, prepayments, and if I yes, please, TA, I can see your hands up.
Good
please
evening,
go
sir.
ahead. Yeah, good evening.
Good evening, sir.
Yeah,
What
good evening. I
about
can hear you.
amortization? Is amortization part of it also or not?
Yes. Amortization is an estimate. You know, depreciation is on physical asset, amortization is on intangible assets. So it's also an estimate.
So will contingent liabilities fall under legal provisions?
Thank you, sir.
Yes, please. Yes, contingent liabilities can fall under legal provisions, of course.
Okay.
Yeah, they are all estimates. Okay, so good questions. Depreciation and amortization could be part of it. Accruals, doubtful debts, expected credit loss, legal provisions, contingent liabilities, prepayments, and deferred tax. So I just use that mnemonic to help you remember some of the estimates. So the auditor's problem around estimates is that estimates involve judgment, and judgments are subjective. That's the challenge. And it can be biased, either intentional or unintentional. So that's where the problem is. It also creates a risk of material misstatement and makes it hard for auditors to obtain objective evidence. So a hook, you could remember, is where judgment enters, then risk increases, because there's nothing static or certain or actual about that assertion. So where there's judgment or estimation, then the risk of taking advantage of that situation to mess up the financial statement, let me use that word, which is the risk of financial statement, increases. So that's where the challenge is. So the key question for the auditor is, are management's estimate reasonable? Whatever they are estimating, is it reasonable and supported by some evidence or supportable documents? And the answer to this question is that the auditor must evaluate the basis for this assumption. What are the bases? You are depreciating land and building. You are depreciating building. What's the basis? Some people tell you can't depreciate building, but building depreciates. The only thing that don't depreciate is land. So what's the estimate? Why are you depreciating building at 10% and you're depreciating equipment at 20%? What's your basis for that? So those are things you should ask. And also consider the expertise and bias of management in some of these estimations, in their reasonableness and reliability. Also, the auditor needs to compare with historical data and subsequent events in these estimates. And this matters because the estimates affect profit, they affect the performance, they affect the position, they affect obligations also. And even small errors can distort the whole financial picture in the financial statement. So it matters very much for auditors to take note of estimates. And auditors must apply professional skepticism and also test the reasonableness of some of these management estimates. So the hook is, take note, skeptic eyes for guessed figures. That's what auditors should do. Have skepticism for any figures that are guessed, they are not certain. So, for example, in my former don't mind me, I'll be using these examples in my former diagnostic space. Could estimate 15 million as legal provision for an ongoing tax dispute. So this estimate 15 million was provided. The auditor must assess the basis. What was the basis for it? Did you get legal advice that you may pay that 15 million? Or out of the past experiences, have you paid legal fines or issues like that around that range? So the auditor must assess that. And he should assess the probability of loss and also the disclosure adequacy under IAS 37, which is the provision for contingent liabilities AA spoke to. So a memory hook to remember around estimates is the estimates rely on judgment, which is E, and the auditor must assess the assumptions, A. Then the risk of material misstatement is high when it has to do with estimates, and that is because of the judgment. So this EAR acronym could help you remember this situation very practically. So that's the nature of accounting estimates and the problem auditors have with auditing accounting estimates. All right. So any question on that short section? Okay, so let's run. Section 2 talks about auditing accounting estimates based on ISA 540. I haven't looked at the problem. The core objective based on ISA 540, which guides auditors on how to obtain appropriate sufficient evidence, is that auditing estimates or accounting estimates are reasonable. The auditor needs to obtain evidence that his concern or he has comfort on the fact that accounting estimates are reasonable based on his judgment and his assessment and the evidence he has gathered, and also related disclosures are adequate. So look around the hook, speaking to reasonable and revealed. So he should look out for reasonableness of these estimates and the disclosure of these estimates, talking about supporting evidences of these estimates. And the focus area, ISA 540 emphasizes rigor and skepticism in the area of estimates, especially where estimates with high uncertainty is glaring at the auditor. So, for example, estimates around fair values, provisions, warranties, where they are high, then he has to be skeptical about it. So, for example, doubtful debts, expected credit losses estimation, inventory obsolescence, like expired inventory, the estimations of it, depreciation and amortization, warranty obligations, legal provisions, contingent liabilities. All these are examples of where he should apply rigorous skepticism to validate these numbers. And also long-term contracts, fair value of assets, liabilities. The auditor has to be skeptical about this. So this little acronym, DWLF, doubtful debts, which are expected credit losses, inventory depreciation, warranty, legal disputes or contingent liabilities, fair value, are areas where the auditor needs to be skeptical about. And key audit steps around understanding how management identifies and makes this estimate is very key. It's very important for the auditor to comprehend first. Then he needs to assess the methods and assumptions used in coming up with these estimates. Any changes from the prior year's estimates, whether up or down, what triggered that change? He needs to ask those questions. He needs to compare the facts with events after year end, talking about subsequent events. He needs to compare the real facts with the actual events. Then he needs to test management's data and controls or develop his own estimates to see if they tally with that of management. Then he needs to review prior estimates to assess their reliability. So these are the steps or key steps the auditor should take in assessing the validity of these estimates. So the hook is he needs to understand first the estimates, assess the estimates, compare them with last year's data, test it, and also review it. So this acronym could help you remember some of these concepts. So the red flags for management bias speaks to frequent method changes without the valued reasons. Could be a red flag to irregularities around estimates. Some unrealistic assumptions, they could be too optimistic or too pessimistic, could be a red flag. An estimate that always favor management's goals should be a pointer to some manipulations by management and could be a red flag. So this acronym talking about change in management estimates year in, year out, unreasonable ones, self-serving ones for management could help point out red flags around estimations for the auditor. Also, we have fair value estimates, and the key risks around this, we have inherent risk we looked at, and the inherent risk around fair value estimates are inevitable. They are uncontrollable by the auditor because they are subjective models, absence of market comparisons. So those are inherent risk and they are inevitable. The auditor cannot control it. But control risk around weak controls over evaluation, then the auditor needs to assess the control risk, and where inherent and control risk is high, he will set detection risk as low. So the auditor may lack valuation expertise and needs an expert to help him in this detection risk area. So he may require the use of an independent expert to check some of these estimations by management. So he must consider the need first, as we've looked at in ISA 610 for an expert. He must ISA 620, I beg your pardon. 610 is the need for an audit, use of audit report. So the need for an expert or use of an expert is ISA 620. The auditor must consider the need for an expert in helping him resolve this issue of estimates, obtain management representation in the area of estimates, and also document the reason and evidence for that. So the ERD hook is that he needs an expert, then he raises a management representation and document the same. So this is a hook to help you remember the ISA 540 on auditing accounting estimates. All right, so any questions on this? And I hope these short acronyms are driving the point home. I just hope it's resonating with you. I just hope so. Okay, so let's look at the next unit, talking about section 3, looking at the IASB alert, talking about challenges in auditing fair value accounting estimates, which is prevalent in the auditing space, talking about the auditing these accounting estimates in the current market environment. So the background spoke to IASB alert around October 2008 during the credit market turmoil. And it warned auditors about fair value audit difficulties, and that IASB alert came as a result of that challenge, and it warned auditors to be careful because that market that time was volatile, and the relevant entities and the financial instruments going concern risk around that time was very prevalent. So the crisis, the credit concern around estimates could flaw the auditor's judgment. So skepticism was to be high, and the IASB's alert was for auditors to be very skeptical, to avoid issuing reports that favor some of these frivolous and management bias estimates. So the key challenges around this speaks to auditors facing difficulty when markets are inactive or illiquid. Markets are inactive or illiquid when issues of estimates cannot be validated by the market or in the market. And also valuation models replace observable prices, and also inputs and judgment become highly subjective. Then auditors face difficulty in assessing the validity of some of these estimates. So areas highlighted by the IASB alert that time were challenges in fair value accounting and unreliable market data and validity assumptions were what they flagged that auditors should take note of. And also relevant ISA guidance, ISA 540 came about, and also ISA 500 on sufficient appropriate evidence, and the use of experts 620 could help guide the auditors on resolving these challenges. And the IASB alert came with these suggestions, and also came with other audit considerations around disclosure, adequacy of these mitigants for estimates, and management bias and the going concern impact of these estimates. The IASB brought to the fore that management or auditors should be very careful in assessing that. Also, the International Accounting Standards Board initiative improved the fair value management guidance by coming up with fair value measurement IFRS 13. And also the upcoming ISA revisions introduce tighter rules for fair value audits, and also the resolution of issues around estimates. So this acronym will help you address the conversation around the IASB alert, talking about the challenges it faced, the relevant ISAs that was provided to mitigate or solve the issue, then other issues, and the International Accounting Standards Board's initiative and revisions of some of the standards to help address the estimates challenge. So the key takeaway for us is that, excuse me, auditors must apply heightened skepticism when it comes to estimates and estimations by management, and use experts where needed, and ensure transparency or transparent disclosures under certain market conditions for the use of estimates. So this acronym C, skepticism is important for auditors, the use of experts is important, and obtaining sufficient appropriate evidence in the area of estimates is key. So this C acronym could help you remember these concepts very graphically. All right, so that's it about the challenge of estimates and the IASB alert that came in 2008 to help resolve this issue globally. Okay, so any questions? I hope we are not sleeping by now. Usually we are quiet.
We are here with you, so.
Oh, okay.
We are here with you.
Thank you. Ah, fantastic. Good. Thank you for that. That means, good to hear. All right, so let's look at the next unit on the audit of accounting estimates. Okay, that was the end of accounting estimates, I beg your pardon. So let's look at the next unit on the audit of specific areas of financial statements. So we have 2 more units, let's run. The audit of specific areas of financial statements. How do auditors audit financial statements and specific areas? The essence of this unit is that auditors must apply ISAs, International Accounting Standards, as guides to obtain evidence on the items in financial statements that were audited, and they are governed by specific IFRSs or IAS standards. So we must obtain evidence by using ISA principles and the concepts with our judgment to arrive at sufficient appropriate evidence. So ISAs meets IFRSs is a key hook you should know. ISAs are used to check IFRSs that management use to prepare financial statements. So auditors must link audit evidence with accounting rules. So focus during your exams, if questions come around this area, is that when auditing IFRS-based items, always consider the 3 acronyms MKT have provided, and they include materiality. So the first thing is, are these items significant enough to affect users' decision? So that's the first thing you should look at when auditing IFRS-based items, financial statements prepared based on IFRSs. Materiality is the first thing you should look at. Number 2 is key requirements. What does the relevant IAS or IFRS demand in the preparation of those financial statements? Are they applied practically and appropriately? So you look at the recognition, you look at measurements and disclosure. So the materiality is the M, the K is the key requirements, and the T is you need to test for evidence that they did the right thing. How will the auditor verify compliance? By inspecting, by confirming and reperforming procedures to validate this. So the key mnemonic in this is you need to check for materiality, key requirements, and test that it was actually applied appropriately. And the key point is that different IFRS is required. It really requires different audit approaches. So auditors must know the accounting rule. Like somebody will say, as an auditor, if you cannot prepare the financial statements, you cannot audit it. And I think I agree with that person. So preparing the financial statements, it's a prerequisite. So you know where the nooks and crannies and where auditors, process owners or financial accountants could hide things. So if you can prepare the financial statements, you can audit it. So auditors must know the accounting rule, assess materiality, and gather sufficient appropriate audit evidence to confirm compliance in this area. That's the key point, and that's an introduction into knowing how to audit IFRS or IAS financial statement items. Okay, so if we don't have any question, we run to section 2, looking at the auditor's checklist for specific IAS and IFRS items. There's checklists, but there are checklists for specific IAS and IFRS items. So IAS 1, for auditors to audit this specific IAS, talking about the presentation of financial statements, the auditor must confirm that the going concern basis is appropriate and properly disclosed if uncertain. So that going concern is very important in IAS1 for the auditor to confirm. As a matter of fact, in the narrative of our financial statements, if you look at those audited, this going concern statement must be there. It's first based on IAS1 aside the other financial statements. So it's a narrative that must be provided by management. And the next one is the accrual concepts and consistency in presentation and classification are maintained. The auditor must confirm this is there in the financial statements. Also, material items are separately shown, and offsetting is only as allowed. So offsetting some of these financial material misstatements or material items must be approved, and the auditor must have a level of comfort that offsetting this of the financial statement, he's okay with it. If he's not, then it must be disclosed. So material items must be separately shown, and where it wants to be expunged, the auditor must be aware and he must consent to that, maybe for a reason or another. And also disclosure notes must be complete and appropriately referenced in those financial statements based on IAS 1. So the auditor needs to confirm these are resident in the narratives in the financial statements preparation and presentation. Number 2 is IAS 2, talking about inventories. Auditors must check that inventories are valued at lower of cost and net realizable value. Very important for IAS 2 presentation of inventories. You must also confirm that the first in, first out or weighted average method are used and not last in, first out. So he must confirm that in the financial statements. He must confirm and also, if possible, carry out physical counts and ensure they are accurate and overheads or expenses are treated properly in the position and performance statements. This is key. Also, IAS 7, talking about cash flow statements or statement of cash flows. The auditor must ensure that cash flows are classified under the operating, investing, and financing activities. This is very primary. And the presentation formats align with IAS 7, which requires accounting policies, estimates, and errors. IAS 7 is what we are talking about. So we said the presentation format must align with the direct or indirect method. And what is encouraged in practice is the indirect method of presentation of cash flow. So the auditor must ensure that the indirect method is used as stipulated by the appropriate IAS 7 standard for the presentation of financial statement of cash flows in financial statements. Then the next standard is IAS 8. Accounting policies, estimates, and errors. The auditor needs to confirm that policies are appropriate and consistently applied across transactions and postings or disclosures in the financial statements. Any changes in policy or prior period errors are treated retrospectively, that is backward, not prospectively. So any issues or period postings have to be revisited in retrospect. So changes in estimates are also applied properly based on IAS 8, and the auditor must confirm and ensure this based on financial statements presentation. Then for IAS 10, events after reporting date, the auditor needs to verify that clear distinction between adjusting and non-adjusted adjusting events is presented. He needs to also confirm adjustments or disclosures made appropriately in the financial statements are there, resident, and also are properly accounted for. So adjusting and non-adjusting events must be clearly delineated in the financial statements. Next one is IAS 12, talking about income taxes. The auditor needs to check current and deferred tax. So current tax is the current obligation, while deferred is a provision made in the future, and they are correctly computed. You must confirm that. So deferred tax is recognized for all material temporal differences. He needs to assert and affirm that. And deferred tax assets are recoverable, and tax rates are appropriate based on the provision and deference of this tax. So the auditor needs to check and confirm this based on IAS 12. And for IAS 16, PPE, the auditor needs to ensure cost determination. What is the cost of these assets and their capitalization, not being expensed at a particular threshold. So he needs to check that most material PPEs are capitalized and depreciation is properly calculated and revaluations handled correctly. The rates applied appropriately based on policies as provided in IAS 8. Also, gains and losses on disposals are properly recognized and posted. Then for IAS 19, employee benefits, the auditor needs to confirm liabilities are recognized for employee services rendered over time. And also related expenses are properly recorded in the correct period they were incurred. Then for IAS 20, the auditor needs to confirm based on government grants that revenue grants match related expenses in profit or loss. And also capital grants are either deducted from the asset or treated as deferred income based on the policy of the organization as enshrined and guided by IAS 8. And for foreign exchange, IAS 21, foreign currency translation, the auditor needs to check appropriate exchange rates as used for translation, the functional currency and the presentation currency. He needs to check for that. Exchange differences are properly recognized based on the statement of comprehensive income or other comprehensive income. So he needs to validate that. Then for borrowing cost, the auditor needs to ensure borrowing costs are expensed unless directly attributed to qualifying assets. So borrowing costs must be expensed, but if they are not directly attributed to qualifying expense, they have to be capitalized. So capitalization rates and disclosures are consistent with the policy of the company as guided by IAS 8 also. Then very importantly, IAS 24, a significant accounting standard, talks about related party transactions. The auditor needs to verify all related party transactions are disclosed. Very key, very, very important. As a matter of fact, he needs to pay close attention to this standard, and that transactions are disclosed to highlight possible influence on results or position. This is key. In IAS 36, he needs to ensure as the auditor that impairment indicators are assessed, recoverable amounts is determined correctly. So impairment is the reduction in the asset value. So he needs to check impairment losses and recognize and allocate them appropriately, or check that they are recognized and appropriately allocated across the assets. The IAS 37 on provisions and contingencies, he needs to confirm provisions are recorded when obligations exist, not when they are envisaged. So he needs to ensure that contingent liabilities and assets are disclosed properly, and also major litigation or legal issues are reviewed as per ISA 501. Therefore, 38, ISA 38, the auditor needs to ensure intangible assets are recognized and valued in line with this standard. And also the useful life of intangible assets and impairment tests are reasonable and they are tested regularly with documented evidence. Also, non-depreciation or amortization of indefinite life assets is also justified. This is very important. Then for investment property, the auditor needs to check the choice of cost or fair value model are consistently applied, and fair value gains and losses are correctly accounted for based on the investment property. Then for agriculture, he needs to ensure fair value changes of biological assets and non-biological assets, and they also recognized in the income statement. And also government grants and agriculture are recognized only when they are received. Then coming to the IFRS, the first time adoption of IFRS, the auditor needs to confirm compliance with policies on the first time adoption and transition from a local or previous framework to the adoption of IFRS. He needs to confirm the assets and liabilities are classified correctly based on the new IFRS law, and any non-compliance are removed and aligned properly with the IFRS. Then for share-based payment, IFRS 2, he needs to check option grants and fair values are correctly calculated and classified. And expenses are spread over the vesting period, not recognized in a particular year. He also needs to check for assumptions, turnover, fair value, and the reasonableness of these assumptions. Then for non-current asset held for sale and discontinued operations, the auditor needs to ensure the criteria for held for sale and discontinued operations are met. So there are criteria that asset must be provided for sale and it must not be in use during the time it is classified as an asset held for sale. So proper evaluation and disclosure of the results of this asset must be accurate or fairly presented. In IFRS 8 on operating segments, the auditor needs to verify segments meet reportable criteria, talking about the several parts of the business, whether local or international. They are reportable, they have reportable criteria, and those criteria are met, and all required information is disclosed in the financial statements. Then for IFRS 9 financial instruments, the classification, recognition, and measurement aligns with this IFRS. Where there are provisions, expected credit loss model, they must be applied where relevant and consistently. Then fair value measurement, IAS 13, the auditor must confirm the principal and most advantageous market identified and used for this fair value measurements. The inputs, the valuation method used are observable and reliable, and they are reasonable also. And the highest and best use concept applies to non-financial assets in the valuation measurement quest. Also, revenue from contact with customers. The auditor must check contract exists and performance obligation identified, before recognition of revenue. So revenue is recognized when control transfers over time or a point in time. So the service must be provided on goods consumed by the client or the customer before revenue is recognized. So financing effects or modifications are treated appropriately based on these recognitions. Then for leases, IFRS 16, the auditor must ensure proper identification of lease arrangements, check discount rates, implicit or incremental, and they are reasonable. Don't forget, finance and operating lease have the same laws now under IFRS 17. Formerly, it was IAS 17 that separated finance and operating lease. And the auditor must ensure that application of portfolios doesn't materially distort results of these leases. Then for insurance contracts, one of the newest IFRSs, the auditor must confirm scope and aggregation of contracts on insurance and confirm they are accurate. And actual inputs are valid, reliable, and independently reviewed. So this is where sometimes auditors need experts. Actuaries could be employed to validate some of these services. So that's it for the checklist on the audits. I had to run through that, and you may need that to go through it again to check what you could do when IFRSs are presented. They could come in some questions. Okay, so we have like 3 minutes more to halt. Let's look at this last unit, then we'll stop. I was hoping we'll be able to finish, but then time is not on our side. So let's look at this last unit talking about ISA 501, the audit evidence, specific considerations for selected items like litigations and legal claims. So let's look at these before we go to bed. So the objective of this is to ensure that the auditor obtains sufficient appropriate audit evidence audit evidence on litigations and claims that may cause material misstatements in the financial statement. So some company go into legal matters. They have legal disputes, and there are some litigations like suing the company, going to court, claims from legal disputes, and all this transpire. So the auditor needs to obtain sufficient appropriate evidence to validate that these things are posted well in financial statements, and they are not materially misstated in this financial statement. So the key audit procedures around this is the auditor needs to inquire from management. And he needs to ask management, and also if there is a legal department, he needs to ask around cases like this, litigations, claims. He needs to be aware of potential legal cases, and he needs to review these cases, review the minutes and legal sittings or the meetings on resolution of these issues. He needs to review how they are deliberated on and how they are resolved. He needs to also examine correspondence between the entities counsel and the external legal counsel, that is between the plaintiff and the how do they put it now legally, the plaintiff and the respondent. Is it respondent now or something? Can't remember the word they use for them legally. So he needs to review both correspondence to see and check for legal expense accounts for evidence of ongoing disputes and claims. He also needs to check for material risk misstatement, material risk assessment on some of these claims. He needs to identify litigation that may create a risk of material misstatement. All he's after is the materiality of some of these cases or these claims. So there's a hook I provided here. You need to think around inquiry, review, and material risk. So when litigation appears material, he needs to carry out the LQ test. And the LQ test talks about the legal quest test. If risk is identified or suspected, he needs to send the letter of inquiry in his quest to get his answers. So send the letter of inquiry to the external legal counsel. That's the person that the counsel that is against per se the company. So the letter is prepared by management, was sent by the auditor to inquire. And the purpose is to get direct confirmation from their lawyer on all material claims and the entity's exposure. He can't ask the company's lawyer because the company's lawyer could be with management. So he needs to externally confirm this and the entity's exposure in terms of value, amount of such claims. So when lawyers cannot communicate, the lawyer is prohibited by law or professional rules from communicating directly. If such is the situation, then the auditor must perform alternative audit procedures to get his evidence. And these procedures could be reviewing court filings, settlement documents, insurance correspondence, and he could get that from the internal company's lawyer or legal department. He should also obtain written representation from management to get audit appropriate sufficient evidence also in the areas of claims. Then when evidence cannot be obtained also, he needs to, or where management refuses permission to contact the external lawyer, or the lawyer refuses to respond to the auditor, and he cannot obtain sufficient appropriate evidence, then the opinion must be modified because he cannot validate or substantiate these claims. The opinion must be modified under ISA 705. Either he qualifies the report or provide a disclaimer of opinion. So the hook is management refusal to culminate in modified opinion. Very simple. So a summary reminder on these legal issues is that the legal checks must be assessed skeptically by the auditor. So the risk speaks to identifying legal or litigation risk. Then he needs to respond to those risks by seeking direct legal confirmation or alternatives. And also he needs to report by modifying the opinion if evidence is insufficient or cannot be gotten. So A quick classroom recap is that ISA 501 provides special items and guides us or auditors on litigation issues. So the auditor should always ask, review, and confirm reports around this. And if the external lawyer did not answer the auditor, or management's refusal to get or write the lawyer, or blocks evidence, then the auditor cannot stay silent. He has to modify his opinion or even qualify it. So that's it about audit evidence and the specific considerations for selected items, mostly litigation claims in the area of estimates and contingencies. Okay, so ladies and gentlemen, we couldn't conclude tonight. We'll continue in our next class, hopefully on Saturday on section 4. So do we have any questions